Hi, and welcome to Fuel Podcasts. My name is Alyona, and I'm CEO and co-founder of Fuel Finance. And we are here to make finance fun and help founders avoid financial mistakes. Today, our guest is Marvin. Marvin is a partner at Diaspora VC and was a partner at 500 startups. And moreover, he invested and worked with more than 400 pre-seed and seed stage startups. What is interesting, Marvin spent 10 years at Yahoo, was a commercial director there, and had an experience in managing P&L statements. So it's like very interesting to hear all your insights from both sides, from experience of commercial director and also experience of an investor. So welcome to Fuel Podcast and thanks for joining us.
Thank you for having me.
So I will start from a very interesting question. It was like, I don't know, my thought during last several weeks. I know that your background is really very impressive, but all we know that many of our financial habits and maybe even like some financial principles, they are rooted in our younger years. What do you think? Going back to all your like childhood or maybe younger years, what type of maybe financial values or practices you have learned, and what do you think how these principles affected your investment strategies now?
Oh, okay. I don't know if any of the I can answer this question in a bunch of different ways, but I think
Mhm.
sort of like the way that you grow up. So so I grew up in I grew up in Canada to immigrant parents. So we didn't have a lot of money, and so it was one of those things of sort of like not really understanding sort of this idea of sort of scarcity versus abundance, not really even understanding like what financial management, right? You're just trying to get through the day and just trying to survive, and which actually ironically has been good and bad, right? Like everything is good and bad. Like it's been good in the sense of just like you're just really frugal, right? Of just like you're just naturally sort of like really value money, maybe too much, right? So I don't know if that's been a good thing for me, where you almost value it too much. You're super frugal. You only spend it on the stuff that actually really matters. But actually, for startups, that's actually incredibly good, right? And actually forces you to really ask a lot of questions. Like, when I invest in companies, like I care a lot in early stage of, and I think I learned this a hard way, as an investor, sort of, it's one thing working at, running the P&L of sort of a fast growing division and group of a large company. If you start running out of money, you can always go back to the mother company and go, hey, I need more money, right? Things are working really, really well. It's very different than, say, having to go to VC or somebody to sort of like raise more money. It's a very different sort of like situation. But I do think having invested in being an operator, having invested where it is helpful, and also going through a bunch of recessions, right? So I went through I was, before Yahoo, I was at a startup that raised a lot of money that didn't spend its money very, very well. So you kind of see what happens when you aren't frugal with money, right? Like you spend it on the wrong things, like, $1,000 Aeron chairs, or spending like $50,000 because like our buildings were sort of like not exactly sort of like connected. So we spent like $100,000 to basically connect the buildings, like so people would not get wet in the rain. It's so dumb, right? Like go like, okay, no big deal. It just is dumb. And so I think your financial habits are actually very important, of just like understanding sort of where you go to. So for example, when I do have money, first time I actually made a lot of money was when I was at Yahoo. I spent it really badly, right? Because like you're like, oh, I have money now, I can do whatever I want. And I actually think that's a big problem for a lot of startup founders, when you go from not making, sort of like the business where it's like you don't have any money, then you raise a bunch of money, and almost every single one of my companies that end up having good rounds, like don't usually spend it well.
Yeah, yeah, that's 100% true, and I want to agree with because I think that I have very similar background that you mentioned. As I should say that like also having financial background is good, especially now during all this like financial downturn, because you started to be very efficient and it's very like natural for you to manage like not a huge amount of money, but do as much as you can from this amount. So
Yeah.
to grow very fast. But
Yeah. I
like
mean,
talking, you already
yeah.
said about this like financial downturn and you said about your experience. So what do you think about this balance between like bootstrapping now, having profitability and also growing fast? So you mentioned that like this experience is very valuable now, but what do you think? So how you recommend startup founders think about this new reality now?
Well, I think one of the things that sort of happens when you have a lot of money, right? So the analogy is sort of I use is sort of like, in some ways, like, I used to be so angry, or it's like, oh, I'm so unlucky. Like, every time, graduate from university, like recession in Canada, went to Asia, Asian economic crisis, came to the US, had like, 1.5 years of like benefits. And then 2001 happened, and I was like, really, that was tough, right? And then 2008 wasn't exactly fun either, but sort of going through these things, but in some ways it actually trains you really well, where it's just like you see these cycles. And so in many ways, I feel so bad for people who sort of like grew up in this environment of sort of, let's say 2010 on, or at least 2012 onwards, right? Where there's lots of money, sort of like zero interest rates, and you just develop a lot of really bad habits, right? So it's kind of like, I joke, it's sort of, not really joke, it is a joke actually, where it's like, it's like you grew up rich, and then all of a sudden, like, your dad's business goes out of business, and then you have no money, right? Like, then you're having to go and make that huge adjustment, versus if you're poor, and then you end up with a bunch of money, like, you're less likely to go and lose that money. And so I think sort of like having that mindset of just like, if you have gone through this crap, like, I just think how tough it would be for like a founder who's, let's say he's raised like 50 to 100 million, it's usually a he, right? Like, raised like 50 to 100 million dollars. Like, that's what, and then they just have developed all these like super bad habits, right? Like hiring people you don't really need to hire, spending money on a bunch of stuff that you don't really need to sort of spend money on. And then you're going, holy crap, like, I'm not going to raise the next round, or if I do, it's going to be terrible terms. And so I need to go make these like hard cuts now. And so I have to cut like 50, 60, 7% of my staff. Do you know how difficult that is? Just like the mindset, the mental sort of like shift that needs to go down. And then, also sort of like how much you end up doubting yourself, because then you're having to go through, and also your VCs don't know this, right? Because most VCs have not gone through this either. I'm old, right? I'm 49. Like, most VCs are in their like 30s, and they just haven't gone through this. And so just like, how can you figure this out unless you've actually gone through this? And are you prepared to go and make those like hard decisions? And so I do think sometimes, like, I've had, as I alluded to, sort of like I've been very, very lucky in my career. But there was one situation where I did make quite a lot of money. Like, I did not manage it very, very well. And it actually forced sort of like massive cash flow issues to basically maybe go and think, okay, I need to go and like start figuring out budgets. I need to start like going and thinking through, like, do I really need this gym membership that I never go to, right? Like, that's like a $200 a month like gym membership. Like, this is useless. Or like, why are we going to the grocery store like 3-4 times a week, and we have like, and buying crap that we don't really need, right? Like, you start forcing yourself to really, really rethink a lot of this. And so I do spend a lot of this. I have spent a lot of this year and a big chunk of last year with a lot of my portfolio companies going through cost structures, right? Of just like, let's go take a look at your credit card bill. Like, let's go and look at your staffing. Let's go and look and just start answering the questions like, hey, is this role really critical? Okay, great. Is this person performing? It has to be yes for both of them, right? Like, and is this role going to be critical for the next 6 months to a year? And forcing you to sort of make those really, really hard trade-offs. That sucks, but like, it's just, I feel like everyone sort of needs to go through this as a founder, or even an individual from a personal finance point of view, right?
What was an average percentage of cutting costs? So that you mentioned, like, with your portfolio start.
I mean, I think because I have such a big portfolio, you have a general idea where it's like, okay, you're pre-seed, and so like your cost structure should roughly be here, right? Like, this is sort of the range, or like, hey, you're like seed, or you're A, like, here's roughly what here's sort of like valuation, here's a sense of sort of like how many people in the organization, here's a rough idea of just sort of, what your cost structure is, right? Your monthly burn rate, and I have a general idea, and that's sort of my first starting point, right? But then every company is different, so this is where you ask a lot of questions sort of like identified. And so you ask this question sort of like growth versus sort of like bootstrapping. Like, bootstrapping is great to really force, that constraint is really powerful, right? Because when something's not working, kill it off very, very quickly. It's bad in the sense when something starts to work, like, you may not always have the capital to sort of like throw into it to grow. And so I do think there's stages, right? So I think pre-product market fit, you want to raise as little money as possible, bootstrap for as long, for as long as you can to get to product market fit. Once you have product market fit, when you start to see sort of the growth, that's actually when you lean into potentially raising money or lean into sort of like spending it, right? And so I had a friend, this is not my analogy. A friend of mine called Patrick, he was a co-founder of Rotten Tomatoes back in the day. So, and he told me the same, to use a poker analogy, right? Like, in the beginning, when you're first starting off, like you have a crappy hand, you play very defensively, right? Like you're very conservative.
Yeah.
You don't do like stupid things. But then sort of the problem is that the mistake they made is once they had product market fit, like they had good hands, right? Like they had really, really good cards. Like they just couldn't get out of the mindset to sort of like shift into growth, where it's like, okay, let's invest money, more money here. Let's hire more people here. Like, no, let's be super scrappy, keep on doing this. Like you're never going to die, but you won't necessarily take advantage of sort of like the opportunity in front of you. So I do think there's a balance, right? And I do think there's a stage. The mistake that I think a lot of companies made, investors and a lot of founders made in the last, I'd say 4 or 5 years particularly, a lot of companies were just raising too much money ahead of product market fit. And so they were trying to sort of like use the money to cover up for the fact that they didn't have product market fit. And if you don't product market fit, you don't product market fit, right? Like there's only so much you can really do against that. And so what ends up happening is just you end up hiring this organization around a business that's not necessarily there yet. Inevitably, like the metrics aren't going to be there, the business not going to be there. And as we saw, like in 2022, like the money funnel ends up sort of like shutting down. So there's a lot of companies in really, really big trouble, like and who are just really just surviving on the money that they raised in the last, couple of years prior, right? They're in a tough situation. And then you can, doesn't matter. You can cut to maybe 80-90% of your staff, but like if you don't product market fit, like you don't product market fit, right?
You will not survive even with that, yes.
It's tougher. I mean, it's just your likelihood of surviving is still very, very low.
Yeah. And what about like this product market fit? Because I also has this idea that you should like be very cost efficient before product market fit and like grow very fast. And when you already like have this product market fit, you can spend money and you understand that you spend and grow faster. But like, what are criteria of this product market fit? So I think it's always like a magic, like for founders, like what, I don't know, like what should be revenue growth from month to month? Or I don't know, you see some other metrics that are growing pretty fast. So what are these criteria when you can be sure, oh, okay, I found this product market fit and now I can spend like money faster and faster because everything like will be okay and we already found this product market.
Yeah, it's product market is super tough, right? And so many people have talked about it. So many smarter people, the more successful people I have actually written about it or spoken about it. I mean, the way I think about the analogy, I use analogies to think about this, where trying to find product market fit is like you're pushing the rock up the hill, right? And it's really, really hard. Once you find product market fit, you're like chasing the rock. And so it's not necessarily even just sort of like the growth rate, even though the growth rate is really, really important. And I think it really depends on the business model. Like you can tell when a business has product market fit is basically they just can't keep up with all the demand of the business coming in. Like literally they cannot service a business, right? They have more customer requests than they can actually service. Like that's product market fit.
Okay. And so this is a criteria. Okay. But anyway, is there any metric growing from month to month? I don't know, like 10%, 20%. So like less than 10% is not like it's like a significant growth. Is it like any metric? Because I think that like you have many situations, for example, for 1 month you already have, for example, this high demand. But for example, for another like several months, you can't have like this the same demand as this was. So is there also about sustainability or like any other criteria?
Yeah, so I look at it really a combination. It could be a percentage point, so anywhere between like 20 to 30% month on month, but over a very long sustained period of time, right? Like not like 3 quarters. Like I'm talking about like, it's like not 3 months, right? Like you're talking probably like 3 or 4 quarters where it's like, okay, something is like going right. Like it could be 10%, month over month, which is not bad. Let's say it's 20%. And so I look at these type of things where it's like, what's a percentage of month to month growth, but also like how long has this actually been happening, right? Like 3 to 4 quarters, like, yeah, you have product market fit, like something's happening, right? And so this is part of the reasons where I'm just like, I think it's very, very hard to quantify it. It's like, you'll know it when you see it. And so I've been very, very fortunate where like I'm watching a bunch of companies. I remember talking to a friend of mine who actually invested in one of my portfolio companies that's now worth like a lot of money, like it's worth a couple $1 billion. I think, I hadn't talked to this company in like 3 years. And I remember like going and like, hey, how's this company doing? Like, you led the A and you led the B. And then he's like, yeah, do you know how much money they made last year, like last 2 quarters? And they told me a number. It was like in like the, like over $100 million. I'm like, what? Like that's product market fit, right? Like it makes sense. Like they're in the fintech space. Like it totally makes sense, but it's just like, wow, like that's product market fit. Clearly that was really, really fast for them. Right. Like, anyways, the point I'm trying to make was it just really depends on the type of company, but you will know when you see it because it's just like you literally cannot keep up with the demand.
Yeah. Yeah, and also for different stages, it's like I understand that's different percentage growth. But when you talk about early stage startups, what do you think about? I think all founders want to know this. So, what about current average valuation? So, is there any formula how, like, for early stage startups? We now talk about like seed stage, maybe Series A. What average valuation do you see on the market? And is there any formula how like this valuation can be calculated?
I mean, some people do the calculation of like, like the, times revenue, right? Like usually at the A is but in general for pre-seed and seed, like there's usually no revenue, right? So you're really looking at it sort of, there's a bunch of factors, right? Like the experience of the team, you're looking at sort of like the market and does a business model make sense? And also just comparing against like all the hundreds of companies that you look at like every month, right? Or well, at least I do. Like you look at all these things where it's like, oh, how much you're raising? Like what valuation? Like is that in range of sort of what I'm seeing right now for your type of business? And what are the different sort of mitigating circumstances? Because every company is different. So you're just trying to judge based on those type of things, right? Like trying to figure out both sort of like, hey, like what else is in the market? So for example, I remember looking at this like travel tech company, and this is many, many, many years ago. And they're like, not that many downloads. Like I was like $30,000-$40,000. Awesome team, really interesting business. But it's just like they're, at that time, this was high, right? Like it's like, well, we're looking for like 15 mil cap. And I'm like, that's really high for like where you're at, right? Like compared to like most of the stuff I'm seeing, like a similar to your business is like 7 mil cap, like I said, many, many years ago. So we've gone beyond that now. But it's just like, this is an illustrative point of just like really knowing sort of the range, right? Like you need to have a rough range of these things. And, I remember like when I started reading, so I left 500 end of 2019. I took like 2020 off and started reinvesting, like investing again in 2021. I remember coming back to the market and they talking to founders with like, what? Like you want to raise like, how much? Like rounds got bigger, the valuations got so much bigger. And it just like, to me was just like, oh, what am I missing? It took me a while to really understand. So like, wow, like, what was going on in the market after stepping out for like over a year, right? And it's just like, oh, like, but then it's gone back down now, right? So, since like 2022, like everything's really, really shifted to where, valuations drop maybe 30 to 50%, which is probably sounds about right.
And for example, for seed stage, what an average valuation do you see now? So I saw information about like from 7 to 10 million on average. So we don't talk about any specific model, something like that. Is it real valuation now on the market for seed stage?
That sounds about right. I mean, it's probably somewhere between like 7 to like 15 on the high end, right? Like I am seeing some stuff in the 15 on the high end, 15 mil caps. But yeah, 7 to 15. And so, I have a bunch of companies fundraising now, not now, but like we'll be coming out fundraising like in September. And, like the conversation where it's like, okay, where's the revenue at? How long have you worked on this business? What the metrics look like? And then trying to sort of like figure out like, yeah, you could probably get away with like, 12 or 15, but like not more than that, right? And there are other ones where I'm just like, yeah, like it's probably like 7 or 8 is probably where you need to go. So it really depends on sort of like where the business is at in general.
If the company wants, for example, to fundraise from you, Marvin, so how do you define a great company from just a good company? So what criteria will be important for you?
Well, I think because I do a lot of pre-seed, right? And some seed, but you mainly pre-seed, where a lot of it's really just sort of like, okay, like want to know about this founder, do they have some specific insight on sort of like their market and what they're working on? And do I think that they're going to stick it out? Because they're most likely going to pivot the business eventually, right? Like, and there's even other factors like business model stuff. Like, is this really like genuinely like a VC backable company, or is this just going to be an awesome business, right? Like, and you can be an awesome business doesn't mean that the VC can back it, right? Because it's just the size of the outcomes that we have. And so I run into lots and lots of businesses that where just like, wow, great team, great business, but yeah, probably not necessary for us. Not to say sort of like it won't be a great business, but as an investment for our return profile, probably just not a fit, right? Like, every deal that I'm looking for 50, 100x of my money, right? Like, because of just the death rate so high versus say like if you're an angel investor where it's like, yeah, 2 to 5x is good. That's not what I'm looking for because I manage sort of like other people's money. So it's just sort of, that's the business model that we look for. And so, I think I look at a lot of the founder stuff. I look at sort of like how well they know their market, and even whether I think the market actually makes any sense at all. Like, it makes any sense to me, whether I think that sort of like this thing really, can be big. Is the timing right for this? Even though the timing question is always hard to answer too. So there's a lot of factors, I think, to sort of like figure it out. And then the other part is like, how does this company in business compare to like all the other companies that we're looking at, or at least sort of like shortlisting, right? To sort of like go and take the next step. So it's a combination of these.
Yeah. Okay. I think it sounds reasonable, and especially for press, it's special about the team and the growth. But talking about, it's interesting to understand because I know that you had experience of managing P&L and you had experience of commercial director at Yahoo. So how do you think this experience impact your current investment strategies? So, or maybe how do you manage, for example, your portfolio of startups, or how do you make decisions about investments? So, do you think this part of your experience had some impact?
Honestly, no, not really. I think managing the P&L has been helpful in the sense of like helping work with companies that to scale their businesses and think about that, right? Like how do you do forecasting? How do you think about sort of like org chart? How do you think about sort of like where you invest? Or even just like, what does your freaking P&L look like, right? Like, is it done correctly, right? How is your forecast? Is it done correctly? As you know, like most of the founders tend to be overly optimistic, right? Versus sort of like when you're an established company and a publicly traded company, like if you get it wrong, like you get punished really badly for it, right? Like in the sense of like they'll your budget, right? Not just got your budget, but also that hits your bonus as well too. And bonuses are a big part, at least when I was at Yahoo, that's a big part of the money that you make, right? Outside of the stock options and stuff. And so it really, really matters. And so, for example, like you can miss a number by like, 5 or 10%. They don't like it. You miss your number by like 40, 50%, like you'll probably get fired.
So it's always about being very precise with your planning, so and more conservative.
Yeah, and that, I mean, in a publicly traded company, that's what you needed to do, right? Like you needed to deliver on your numbers. Like they're reasonable, where it's like stuff happens, right? Like sometimes stuff happens, and as long as sort of like you can find ways to make up for it, or maybe you purposely, as long as you guide toward like, hey, we're going to potentially miss a number. Here's what's going on, but we have revenue that's going to show up next quarter that's going to make up for it. So you have to, that it was a good education for me, sort of how to manage that way. With startups, it's different, right? And so like the realities on most startups like forecasting is terrible, and they're always wrong, like almost always wrong. They're either way too optimistic in the sense, and this is most of the time, right? Or a lot of times like just the business just blows up in the good way. And so like they were too conservative, like, it's hard to tell sometimes, but just like they end up missing their number because the number's coming way better than they thought, right? Because they got product market fit faster than expected. And so that's usually what I've seen, at least in my sample set of companies, where most of the time they miss their numbers dramatically because just like the market, it always takes longer than they think for the market to show up. But there are some rare cases where it's like, wow, like all of a sudden, like everything just sort of works and the business just explodes.
What other financial mistakes you saw in your startups that you worked with? So forecasts, I believe it's a usual problem for everyone. So everyone has this, like this growth like very fast and some predictions with that. But any other mistakes you think were crucial?
Do you know the biggest thing? They don't do good accounting in the sense of like, I don't expect you to have like, use like KPMG or PwC, like that type of accounting. But I'm like, just having a handle, like I can't tell you how many times where it's just like you hear from a founder where it's like, oh crap, I miscalculated this thing, I miscalculated cash flow, or was overly optimistic about this other thing, and we're actually going to run out of money like in a month from now. And I'm like, what? Like that shouldn't be happening, right? Because like they just overly optimistic or just not doing proper accounting and not managing their cash flow properly.
Yeah,
Like that all the time.
Proper accounting is a huge problem, and I think like, but what they see like proper accounting bad like was just allocating costs, and how do they make decisions based on that? Or for example, like because I solve problems, for example, with unit economics calculations, like
Yes.
just
Well, I mean that's a huge. Let's not even talk about unit economics calculations, right? Where like for me, I always ask a lot of questions about unit economics. Like it has to be in range of what I know about the market, right? Like what I see is sort of like good versus bad unit economics. But yeah, they always get it wrong because what ends up happening is they're overly optimistic about lifetime value, and they're like not conservative enough about, in my opinion, like they're way too, they need to be way more conservative both on, so they need to be aggressive, in my opinion, sort of like really overestimating sort of like customer acquisition costs, and they need to be super conservative about like lifetime value. And they get along. They do the reverse, right? Where it's like, oh, like normal CAC in my industry is like $5, and we're so smart, we're gonna do it for $1, right? I'm like, okay, that makes no sense, right? But whatever. And then sort of lifetime value is like, yeah, it's like 5-year lifetime value. I'm like, dude, that makes sense. Like, no, right? Like, or they're gonna like the customers come back like 20 times, and I'm like, no, right? Like just. So I think that's what happens. I think they get unit economics wrong. These are really gross exaggerations. So no, I see most of my founders will not make calculations like I'm making, being very exaggerated. But this is sort of like, but this is actually what they're doing on a smaller scale, right?
yeah, it's true. I also saw like I think over optimistic it's like usual case in all calculations for unit economics, for forecasting, for everything. So and usually it's like on the one hand it's like I don't know, it's strange how this problem is still very actual, but what I see that usually like we try to like make several scenarios just to be like in line. So you have one scenario, okay, you can be optimistic, you have target goals for sales team, but on the other hand, like, okay, let's have another scenario. So what if, like, what will be in that case? So I think it's a good practice just to think about such cases, not to have as a goal, but for example, have more pessimistic. What do you think about these pessimistic plans? Do you ask your startup founders like to make another forecast, for example, like, to have it just in case?
Yeah, I usually like I do think it's always a good idea to have sort of like, I think as a good business person, you want to have like, you want to be optimistic, right? I think it's actually very valuable. I think sort of like, that's why you do this, right? Like you have to be optimistic and try to make things happen. And that's way more important than being a pessimist, in my opinion. So I think naturally most founders are optimistic, but I think a good business person and a good founder has sort of like an optimistic plan is sort of like a plan B, right? Which is like, understand the best case scenario, but you need to understand the worst case scenario as well too, and plan accordingly, right? Like that's just prudent in my opinion. So kind of understand both. Obviously you're going for the optimistic case, but the pessimistic case where it's like, okay, what's the absolute worst that's going to happen? And we, even when I was at Yahoo, we did do those things of just like, okay, here's sort of scenario number one, here's scenario number two, and a lot of them were driven by, okay, if we invest, like, if you give us this amount of budget and this amount of headcount, I can do this, right? But if you only give me this is what I can do. And so I think you want to have different scenarios. I do think doing that, and it's something I encourage my companies to do. They don't always listen, but it's something I encourage my companies to do, where it's like, it is helpful to have sort of optimistic and pessimistic scenarios, right? Best case versus worst case scenario. You want to understand both.
Yeah, I totally agree. And it's also a good example. So what you mentioned about play with different budgets. So it's even not about like your growth or other stuff. So it's about understand what you will do with different budgets. It's always a good practice to calculate both scenarios and to calculate, okay, what will be if I will add marketing and sales budget? So will it be significant growth or no? Because usually it's an interesting answer of this question. So that with additional budget, so it also can be a case that you don't understand how to invest this money, as you mentioned, like when we started this conversation. So that you see that many companies just not understand how to invest money that they raised.
I just think it's the same thing, right? Like think about like, it's not quite the same, but the analogy is lottery ticket winners, right? People win lotteries, like they just spend their money on like stupid things, right? Because like you just don't know. Like I think it just changes your brain when all of a sudden you have a lot of money sitting in the bank and you're like, oh, what do I do with this? I should do something with it, right? When maybe the best case is just to sit it, let it sit in the bank, and come and until you have a plan to sort of like execute against it. And so I do think this is, I think it's a wiring, right? So like really understanding, like we all have like really, everyone has a weird relationship with money.
Yeah. Yeah, that's true. But what do you think about, I think it will be already my last question. So what do you think about top 3 recommendations for early stage startup founders, if they will ask you about recommendations in financial management? What will it be?
I think number one, like just, really, really sort of like budgeting is really, really important, right? So like the basics accounting, like manage your cash flow like super tightly. Like if you don't have product market fit, and you have to be honest, both founders should be honest with themselves of like, you don't have product market fit. I don't care what you think, like you do not have product market fit, so you need to sort of like act accordingly. But like bearing that in mind, it's just like, you just got to be so cautious with your money, right? It's just like thoughtful with your money, how you spend it, budget, sort of manage and budget it well, watch your cost structure really, really tightly. And that's job one, right? Because your job, money is time, time is money, right? Like that, those are very, very closely tied together. The more time that you have to sort of like, to sort of like iterate and fix stuff and build stuff is good for you, right? The other thing I would say is just sort of, you have to sort of like think about the trade-off of money and time. If it requires you to spend some money to sort of like learn the answer faster, even if it's a negative answer, you should probably spend the money, right? Because
Yeah.
of just like that allows you, because, I've just seen so many times where it's like, wow, like I've written off this company, like, you have your big portfolio. So it's like, wow, they're going to run out of money and yeah, they're done. And all of a sudden, just like they survive because like they just make these changes, right? They either pivot the business into a different market or pivot the business model. Something happens, and all of a sudden they just get all this demand. And so it's like, I never count any person out. I never count any startup out, like until like they go and say we're shutting down, like like we're like until that happens. Like most of the time, like just I'm always surprised in this business, and I think the point I try to make about this, right? Like you said, the top 3, but the biggest thing is just like watch your cost structure, understand sort of the balance of sort of like time versus sort of like money. Where like if you need to spend the money to get to an answer faster, whether it's sort of like investing in hiring somebody to sort of like to help you with a specific area, or investing in sort of like building out certain product features, or running some bunch of tests, like spending money for a bunch of like marketing tests or whatever, you should probably do it, right? Like go and figure out what that trade-off is. And the other part is just really, really sort of like have a good understanding of sort of like your milestones, right? Of just like how are all the things that you're doing, how is that going to sort of like enable you to sort of like hit that milestone? And that means like really hard prioritization and making sure that they're really closely tied together, because a lot of times you see these things where it's like your milestone is this, but you're working on all these other things that actually have nothing to do with sort of like getting anywhere close to hitting your milestone, right? And so it's like,
Yeah.
I remember Keith Boyce, and I don't know the dude personally, but he said this thing that was like really helpful. And I think this is tied into your question, which is, he's like, you're going to ask like the founder, like, what are your priorities? And it's like, okay, great. The founder tells your priorities. And then it was a great exercise to do. And then you're like, okay, show me your calendar. And you look at the calendar like, well, wait a minute, like what you're spending all your time on has like nothing to do with sort of like any of your priorities, right? Like, and so
Yeah.
that's usually huge. Like, so for example, like I have some founders like, I'm fundraising. I'm like, okay, great. Let me go look at your calendar. Like you spent like 4 hours this week on fundraising, right? Like there's like that. That's clearly not your priority.
Yeah, that's true. And it's a very good point that you mentioned about like achieving your goals and analyze what time do you have, what time do you need, and what money do you have, so what resources do you have. So I think it's a very good point. So just balance between time and money, and to get final results with that money that you have. So that's a very valuable point.
And easier said than done, right? Like it's hard. It's hard.
Yeah, it's very hard. I think that like I also like founder and I have the same feeling now and the same understanding of finance. So managing this time and money and like being between just to achieve the goals, all the goals with the money that we have now before the next fundraising. And actually it's a very valuable insight that I got like during I think last year. So yeah, that's 100% true. Thank you so much, Martin, for this conversation. I hope it will be very valuable for all founders with many insights. And thank you for sharing all these recommendations. Hope that founders will avoid many financial.
Yeah, I hope so. I hope so.
Thank you so much.
Thank you for having me.